Dear students and viewers, I welcome you with another exam style question on the subject of financial management. This question will test your knowledge and make you learn the concept of dividend cover ratio. Venus School of Accountancy is committed to providing free learning to students from all walks of life. To watch other exam style videos, please explore my channel's playlist. Please also subscribe to my channel to stay informed about new videos. Today's question is based on the following information. Profit before taxation, $750,000. Taxation, $150,000. Consequently, profit after taxation are $600,000. That is the difference between $750,000 and $150,000. Ordinary dividend proposed is $150,000. The ordinary dividend is basically given to common stockholders. So retained earnings or profits are $450,000. That is the difference between profit after taxation of $600,000 and proposed dividend of $150,000. You're also provided with additional information that the market price per share is currently 83 cent cumulative of dividend. And Lilydale, the company whose data we are considering, has 5 million ordinary shares or common stock in issue. So based on this information, what is the dividend cover ratio of Lilydale Company? Option A, 4, option B, 3, option C, 5, option D, 2. To correctly answer this question, we need to understand the concept of a dividend cover ratio or DCR. The dividend cover ratio tells us how much dividend a company can pay vis-a-vis its earnings per share or EPS. Generally speaking, a dividend cover ratio of 2 is viewed as good, as this indicates that a company has the capacity to pay its dividends twice over. A dividend cover ratio of below 1.5 is viewed as a possible concern, signaling the use of loans. The next question is how a dividend cover ratio is calculated. Well, the dividend cover ratio is calculated by dividing the company's earnings per share with dividend per share. In an equation form, this may be expressed as dividend cover is equal to earnings per share divided by dividend per share. However, to apply this formula, firstly, we need to calculate the dividend per share. That is calculated by dividing ordinary dividend with the number of ordinary shares or common stock. It may be expressed as dividend per share is equal to ordinary dividend divided by number of ordinary shares of common stock. Since the ordinary dividend is $150,000 and there are 5 million ordinary shares of common stock, therefore we will divide $150,000 with 5 million to arrive at a figure of 3 cents per share. That will be the dividend per share. Secondly, we need to calculate the earnings per share, that is calculated by dividing after tax profits or earnings by number of ordinary shares or common stock. From the question, we know that after tax profits are $600,000 and the number of ordinary shares is 5 million. So earnings per share is equal to $600,000 divided by 5 million. And this gives us a value of 12 cents as earnings per share or EPS. Now we can calculate the dividend cover ratio by dividing EPS or earnings per share of 12 cents with dividend of 3 cents. So the dividend cover is 4 in this case because EPS is 12 cents, whereas dividend per share is 3 cents. 12 divided by 3 is equal to 4. This implies that Lilydale can pay its dividend 4 times its current earnings. As I told you earlier, that a dividend cover ratio of 2 is viewed as good, and this indicates that a company has the capacity to pay its dividends twice over. So, with a dividend cover ratio of 4, the position of Lilydale is quite strong. So, based on this discussion, the correct answer is option A, that is 4. If you have enjoyed this video, please do subscribe to my channel. Click the bell icon for notifications and also share and like this video. Thank you for watching.